Hello guys, welcome to my YouTube channel. My name is Nyakwaka. I'm a financial analyst and a full-time forex trader. Today I want to take this wonderful moment, and I have created this YouTube channel specifically to teach those who don't know how to trade, those who don't understand some indicators, how to execute different market orders, to get to understand what happens in forex and how things are being done in forex trading, both fundamental analysis and technical analysis. So I want to start by explaining what forex is. Forex in full is simply just foreign exchange, and it's exchange of currencies. You exchange one currency for another. You exchange, let's say for example, Australian dollar to United States dollars. We have euros to Swiss franc. We have euros to Great Britain pounds. We have euros to Japanese yen. We have euros to United States dollars. We have Great Britain pounds exchanged to Swiss franc, Great Britain pound to Japanese yen. We have several pairs, and currencies are always traded in pairs because you are simultaneously buying one currency and selling the other currency. So that brings us to different types of currencies that are being traded in foreign exchange. We have major currencies. We have one, major currencies, and two, minor currencies. Three, we have what we call exotic currencies. So remember, these are currencies these are three major types of currencies. So we are going to start by defining what major currency and their examples, minor currency, and finally what exotic currencies are. So we're going to start by major currency. We're going to start by major currency. We have major currency. So major currencies, they are major currency because their liquidity and volatility in the market is very high as compared to the minor and exotic currencies, and they are always 7 in numbers. So we have United States dollars. 2, we have euros. 3, we have JPY, stands for Japanese yen. 4, we have Canadian dollar. 5, we have Swiss franc. 6, we have euros, Canadian dollar, Swiss franc, Japanese yen. We have Great Britain pound, and lastly we have Zimbabwean dollar. So any other currency apart from these 7 currency are referred to either minor currency or exotic currency. So minor currency, these are any other currencies apart from United States dollars, apart from euros, apart from Japanese yen, apart from Canadian dollar, apart from Swiss franc, and Great Britain pound, and Zimbabwean dollar. So exotic currencies, these are currencies from the third world economies. Third world economies. Those are exotic currency. Third world economy, for example, we have South Sudan dollar. So this is an exotic currency. So remember, I've told you that currencies are traded in pairs, simply because we are simultaneously buying one currency and selling the other currency. For example, here we have Australian dollar. So Australian dollar, we are buying Australian dollar, and at the same time we are selling USD. Here we have euros and Swiss franc. We have Great Britain pounds and euros. So the reason why currencies are traded in pairs is because you are simultaneously buying one currency and selling the other, right? So we have different types of currency pairs. We have different types of currency pairs. One, we have major currency pairs. Two, we have minor currency pairs. So major currency pairs, these are pairs that are paired to United States dollars. Any pair that is paired to United States dollar is a major currency pair. So for example, here we have United States dollars paired, we have Australian dollars paired to United States dollars, we have euros paired to United States dollar. This is a major pair. We have Great Britain pound paired to United States dollar. We have New Zealand dollar paired to United States dollars. We have United States dollars paired to Canadian dollar. We have gold paired to United States dollars, or ZAW paired to United States dollars. Those are major currency pair. This is silver paired to United States dollar. Any other currency that is not paired to United States dollar is a minor currency. Any other pair that is not paired to United States dollar is a minor currency pair. For example, here we have euros paired to Swiss franc. We have euros paired to Great Britain pound, euros paired to Japanese yen. We have Great Britain pound paired to Swiss franc. We have Great Britain pound paired to Japanese yen. We have New Zealand dollar paired to this pair here. So any other pair that is not paired to United States dollar is a minor currency pair. So we have charts where the tug of war between buyers and sellers are portrayed in the market. So we have three different types of charts in the market. We have one line chart, So we have three different types of charts in the market that portray what buyers and sellers doing in the financial market. So we have one we have line chart. Two, we have bar chart, and finally we have candlestick chart. So all these are charts. So the line chart It portrays the price movements in the chart the same as bar chart, and we have candlestick charts. So I'm going to discuss each and every one of them, their anatomy, how they look like, and what is the most important chart to use. So I would not choose for you which kind of chart that you're supposed to use, but instead from your own understanding and your own research, you're the one who is going to decide whether to use line chart, bar chart, or candlestick chart. So I'm going to start by defining or showing you what a candlestick chart look like. So we have candlestick chart, we have line chart. Let me show you how a line chart look like. Line chart, so I'm going to click there so that you see how a line chart look like. So let me just remove some indicators for you to understand what is going on here. Just a moment. I'm just going to remove the moving average so that you can understand what is going on. And these so we have a line chart. So line chart represent the closing price of the currencies joined by one line. So you see at this point, let me just zoom in so that you can see what's going on here. This is the closing price of currencies, closing price of currencies that are joined by a line to form what we call a line chart. So you can easily tell what trend the currency or what trend the pair is in. You can see here the currency is on a downtrend, and then at a point it was in a consolidation and then came back to a downtrend, and then uptrend, and then going up. So line chart is basically closing prices that of currencies that are joined together by a line to form what is called a line chart. So secondly, we're going to bar chart. So a bar chart looks like this. We have two types of bar chart. We have two types of bars, not bar chart, but bars. Sorry. So we are at bar chart. So a bar chart looks like this. We have two types of bars. We have two types of bars. We have bearish bar and bullish bar. So the moment you hear of bearish emanated from the word bears because the way bears normally fight, they normally drag their enemies onto the ground. So the moment you hear the word bearish, it means the market is on a downtrend. And the moment you hear the word bullish, bullish emanated from how bulls normally fight their enemies. They thrust their enemies into the air. So when the moment you hear bullish, it means the market is on an uptrend. So we have two types of bars. We have bearish bar and a bullish bar. We're going to start with a bearish bar. So a bearish bar, it means the price is moving on downtrend. So what does that mean? It means that the price opens at the top and then runs all the way and closes at the bottom, and we have the upper wick and the lower wick. So that's how a bearish bar looks like. So this is the open of the bar chart, and this is the high of that chart. This is the close, the point at which the price closed at, and this lower wick is what we call low. This is the low, this is high. So the open price is the point at which the price opened at during that time frame. We have different types of time frames. We have 1 minute time frame, we have 5 minutes, we have 15 minutes, we have 30 minutes, we have 1 hour, we have 1 day, 1 hour, we have 1 day, we have 1 day, we have 1 month. And then the second type of a bar chart is bullish bar chart. Bullish bar chart. I'm going to show you on the real chart to see how it looks like. We have bullish chart. So bullish means that the price is going up. Remember, I told you something bullish means that the price is moving up. So it means the price opened at the bottom from the left side, went all the way up and closed at the top, and we have the upper wick and the lower wick. So this is the point at which the price opened at, this is the point at which the price closes at. So you can see that upward movement, and then we have the low and the high of the price, low and the high of the price of the price. So we have two different types of candlestick, of bullish and bearish. So when we go to the market, you'll see how it looks like. So the red ones are you can see this red bar. It means the market opened at the top from the left side, went all the way down and closed at the bottom. We have the lower wick and the upper wick. So this is a bearish bar chart. And then we have bullish bar chart. It opens at the bottom from the left side and then goes all the way up and closes at the top to the right hand side. So we have the lower wick and the upper wick, so you have to note that. So the third and the most important chart is, the reason why I'm saying it is the important chart is because it gives us more information as compared to the two charts. So the candlestick chart looks like this, and the candlestick chart looks like this. Excuse me kidogo. Yeah, a candlestick chart looks like this. it looks like this. So we have two types of candlestick chart. That's just the same as a bar chart. We have two candlestick charts. Sorry about that. We have two candlestick charts. Two candlestick charts. One, we have bearish candlestick chart, and two, we have bullish candlestick chart. So remember, I told you that bearish means that the price is moving downwards. Bullish means the price is moving upwards. So when you are drawing the anatomy of a bearish candlestick, you'll have to consider where the price is opening at and where it is closing at. So a normal candlestick looks like this. It has a rectangular body and upper and lower wick. So remember, we said that something bearish means a downward movement. So it simply means that the price is opening at that point and it closes at this point, and this upper wick and lower wick represents high and low of the price. So the upper wick represents the highest point at which the price reaches during its formation. We have different types of time frames. We have 1 minute time frame, 5 minutes, 15 minutes, 1 hour, 30 minutes. We have 1 day and 1 month. So it depends on which it depends with the type of a time frame you prefer using. So this is a bearish candlestick. Mostly in the chart, it is either colored or it's either colored or it is shaded. It can be black in color, it can be red. It depends with the color preference that you prefer or you have customized your chart with. So we are going to look at the second type of candlestick chart. So have bullish candlestick. Bullish means the price is moving upwards. So if you can guess, it means the price is opening at the bottom here. This is where the price opens at, and then it closes at the top, and the lower and upper wick are constant both in bearish and bullish candlestick. So this is the high and this is the low of the candlestick. So in the real chart, bullish candlestick can either be portrayed as blue, it cannot be colored. It is different from bearish candlestick. So remember, there's that upward movement of the price, and a single candlestick it depends with the time frame that you have set your chart on. The type of time frame that you have set your chart at, we have 1 minute time frame. If it is 1 minute time frame, it means this entire candlestick takes 1 minute to fully form. We have 5 minutes. If it is 5 minutes, this entire candlestick takes 5 minutes to fully form and close. It takes 5 minutes to fully form. We have 15 minutes, the same, 30 minutes, 1 hour. We have 4 hours. We have 1 day and 1 week and 1 month. So it depends with the time frame that you have set your chart at. So if it is 1 month, it means this entire candlestick takes 1 month to fully form. So I'm going to show you how it looks like at the real chart. So here we have candlestick chart. So remember, accumulation of both bearish and bullish candlestick form what is called candlestick chart, and that's what we study, and it has more information as compared to the two charts that we have seen earlier on. We have line chart and bar chart. It has more information. So remember, the body of the candlestick, it has more information as compared to the two charts we have talked about. So the candlestick has got two major parts. Sorry, I didn't mention that earlier on. So this rectangular part is called a body, and these upper and lower protrudings are what you call wick, or you can as well call them shadow, wick or shadow. And remember, in candlestick we have two major types of candlestick. We have bearish and we have bullish candlestick. So in a chart, this is how the both candlestick look like. So remember, we have said that a candlestick has got two major parts. For example, when you look at this green candlestick, I told you this green candlestick is a bullish candlestick. We have two major types of candlesticks, and we have the anatomy of a candlestick. The green rectangular part represents the body. This is a body of a candlestick, and you can see the upper protruding and the lower one. It's called a wick. So remember, the body of a candlestick is very, very significant because it portrays the kind of pressure that is the market. When you see a candlestick with a huge body, with a big body like this one here, it gives us information that bulls are dominating the market. It gives us information that buyers, you can as well say that bulls are dominating the market because the price is moving upwards, and afterwards you can see there's that upward movement up to that point. So the body of a candlestick is very, very significant because it portrays the kind of pressure that is in the market. When you see a red candlestick with a huge body, it tells you that sellers are dominating the market. This is a 15 minutes time frame. So you can see this huge candlestick here, which shows that sellers, or as well you can say buyers, have going to dominate the market. After this, you can look at the succeeding trend. It's going bearish. Are we together up to that point? So also the size of wicks is very, very significant. The size of wicks is very very significant because the upper wick represents the high of the candlestick and the lower wick represents the low of the candlestick. So remember, during this 15 minutes time frame formation, this whole candlestick will be moving up and down. There will be that tug of war between buyers and sellers. So the candlestick with a huge with a longer upper wick shows us that at a point buyers were dominating the market, and due to some reasons we don't know, sellers are overpowered buyers and closed the market downwards, and that's why you can see this candlestick has got an upper longer wick. Remember, that is very, very significant, and it is very, very important for you to note that, because after that you can look at the succeeding trend. It was on a bearish trend, or you can as well say it was on a going short movement, which is very, very significant. Also, a candlestick with a longer wick shows us that during that 15 minutes time frame formation, at a point sellers were dominating the market, but due to some factors that we don't know, due to some fundamental factors or economic or any other factor that we don't know, buyers came in and dominated the rest of the period, and that's why you can see the market was pushed up. You can say that now the succeeding trend will be it's going to be either upwards or it's going to be on a consolidation mode. You can see the market moving that way, so it is very, very significant, and you should note that. You can look at the way the market went upwards, so it's very, very significant to note. The most important chart to look at when you want more information is a candlestick chart. So in our next lesson, we are going to discuss about trend lines, support and resistance, channels, how to execute market orders, and also we're going to talk about 3 types of forex analysis: fundamental analysis, technical analysis, and another one, sentiment analysis. So stay tuned. In case you haven't pressed that subscription button, please do so, and also don't forget to press that notification bell to get notified each and every time I drop a new video. Thank you. See you in our next class.